Okay, let's get right into it. If you're an investor, there's probably one big question that's been on your mind, maybe even causing a little bit of anxiety, and it's this. When it comes to your systematic investment plan, your SIP, is it time to stick with it or is it time to hit the stop button?
And what's at stake here?
Now, to really have to hear this one powerful statement that's been going around. It basically says, if the market is standing today, it is only because of SIPs. Wow, that is a huge claim, right? And it gets right to the heart of why this decision feels so important.
And look, this isn't just some vague idea or an opinion. The numbers back it up. Big time. Every single month, a staggering 30,000 crore rupees is flowing directly into the market. And the most incredible part? This isn't coming from some big faceless institutions. It's coming from millions of everyday investors. People like you, people like me. That's the collective power we're really talking about here.
On one hand, we have this incredibly strong foundation for the market, built on our money, all of us together. But that just brings the spotlight right back around to you, the individual investor, staring at that one big personal question. Do you keep going or do you hit pause?
So to figure out your next move, we first have to really understand the ground we're standing on. Let's dig into how these SIPs are actually propping up the entire market and creating this foundation of stability.
And just as a quick refresher, right? A systematic investment plan is really just a disciplined way to invest. You commit to a fixed amount regularly. The real magic isn't about how much you invest, but it's all about that unwavering consistency, month after month.
Now let's zoom back in on that massive number again, 30,000 crores. What does that inflow really mean? It's the sum total of millions of us all acting together every single month without fail.
Yeah, this slide shows it perfectly. This isn't some random trickle of cash. You have to think of it more like a constant, predictable, powerful river flowing into the market. And that flow acts like a massive pillar holding up the entire structure. It gives the market a kind of stability and resilience that's frankly hard to overstate.
This brings us right to the core of the problem, doesn't it? The market is stable precisely because everyone is continuing their SIPs. But what's good for the market as a whole doesn't always feel right for your own personal strategy, especially when things start to look a little shaky. So how do you navigate that conflict?
Totally logical question, right? If our collective action is the very bedrock of the market, why on earth would any one of us think about stopping? Well, the answer usually comes down to a very powerful, very human emotion: fear. We are just wired to feel the pain of a loss way more intensely than the pleasure of a gain, and that fear can push us to make some pretty reactive decisions.
To fight that feeling, we've got to change our focus. We have to zoom out and adopt a long-term perspective. Because for any successful investor, the way you think about things is so much more important than how the market is behaving on any given day.
This slide just breaks it down perfectly. On the left, you've got the short-term reactive investor. They get sucked in by the daily noise, the headlines. Their decisions are driven by those raw emotions of fear and greed. They're always trying to guess what the market will do next. But on the right, you have the disciplined planner. Their eyes are on the prize, their long-term goals. They get that success comes from time in the market, not from trying to time the market. So the big question you have to ask yourself is, honestly, which one of those columns describes you lately?
Okay, so this brings us to the final, and I think the most important part. Look, this isn't about me giving you some magic answer. It's about giving you a framework, a way to think, so you can make the choice that is absolutely right for you and your own goals.
So before you make any move, just pause and really ask yourself these questions. Be honest. Go all the way back to the beginning. Why did you even start this thing? Was it for retirement, your kid's education, a down payment on a house? Has that actual goal changed, or has only the market's mood changed? You know, reminding yourself of your original why is probably the most powerful weapon you have against short-term panic.
The heart of it, isn't it?
The decision to continue or to stop your SIP, it's not really about what the market did today or what it might do tomorrow. It's about your plan for your tomorrow. It's about staying true to the strategy you thoughtfully laid out for yourself from the very beginning.
So, we'll leave you with this final thought. We started this whole conversation by asking, when should I stop my SIP? But maybe that's the wrong question entirely. The real question, the one that truly holds the answer you're looking for, is why did I start? Figure that out, and I promise you, you'll have all the clarity you need.
Let's dive into a real head-scratcher that a lot of investors in the Indian market are facing right now. On one side, you've got all these strong economic fundamentals, you know, the kind of news that should be making stocks just take off. But on the other side, the market's behavior is telling a totally different and frankly, a pretty confusing story.
Are we staring down a period of redemption, or are we on the verge of a huge resurgence? Let's see if we can make some sense of these signals.
And this right here is the question at the absolute heart of it all. It translates to, everything's fine, so why is the market falling? It's such a simple question, but it perfectly captures this massive contradiction. Despite all the positive economic signs, the market just isn't playing along like you'd expect, and that's leaving a lot of people scratching their heads.
Now, our first clue in this whole mystery is a big one, 40%. That's the percentage of investors who have already pulled out and left the market. I mean, that is a staggering number. It tells you that something pretty serious is bubbling up just beneath the surface. Analysts are pointing to all sorts of things. Fears that stocks are way overvalued, maybe some global economic jitters making people extra cautious.
Okay, so to really piece this puzzle together, we've got to unpack these signals properly. So in this first part, we're going to look at the actual data points that are creating this weird disconnect between all the good economic news and this worrisome market reality.
Look at the negative side of things. There are two huge problems. First, that massive 40% exit rate we just talked about. And to make things worse, redemptions, which is just a fancy way of saying people are actively pulling their cash out, are also steadily going up. I mean, these aren't just little tremors. These are major warning signs that investor confidence is pretty shaky right now.
And yet, this is where the puzzle gets really tricky. Because on the flip side, there's a wave of genuinely good news. We're talking about really positive developments in the economy. Strong company earnings, a great GDP outlook. These are the kinds of reports that should be fueling market growth and making everyone optimistic. But they're not.
Brings us right back to the central mystery. What is actually going on? How can both of these things be happening at the same time? It's like you've got this solid concrete foundation of good news, but the building that's sitting on top of it feels like it's starting to wobble.
All this conflict has brought the market to a really critical point, a crossroads. And as we're about to see, the path forward from this exact point could split into two wildly different directions.
So, what do we mean by a market crossroads? Well, it's just a moment of peak uncertainty. All that tension between the good economic news and the bad investor vibes has to resolve itself somehow. And the way it does is probably going to define where the market goes for the next few years.
And here they are, those two potential outcomes laid out for you. Experts have pretty much boiled the future down to these two possibilities. On the left, you've got the chance of a Mushkil 3 Saal, which means a difficult 3 years. And on the right, the potential for a Bada bounce back or a big bounce back. I mean, you can't get much more different than that, right? All right, for our final section, let's really explore what these two potential paths could actually look and feel like for anyone who's invested or even just watching the Indian market over these next 3 years.
Scenario 1, the difficult years. If this trend of investors heading for the exits and pulling their money out keeps up, well, we could be looking at a long period of stagnation. In this version of the future, the market just struggles to get any momentum. Returns are low, and it would really test the patience of even the most die-hard investors.
The other side of the coin.
But then, the great resurgence. In this scenario, all that underlying good news finally plunges through the fear and uncertainty. Confidence comes roaring back, money flows back into the market, and those strong fundamentals finally drive a really powerful and sustained recovery. A big bounce back.
Just nails it, doesn't it? The point of all this isn't to try and predict the future. I mean, nobody can do that. The real goal is to understand the forces that are at play and the different ways this could all shake out. Because, that understanding is the absolute first step to being ready for whatever comes next.
And that brings us right back to the ultimate question. Bounce back or a long silence? Will the market's strong foundation finally roar back to life? Or will all this investor caution lead to a long, quiet period of stagnation? This is the core dilemma, the crossroads where the Indian market stands right now. Thanks so much for tuning in.